understanding double taxation avoidance agreements. Imagine paying taxes twice on the same income. Not ideal, right? That's where DTAAs come in. DTAA stands for Double Taxation Avoidance Agreement. It's a treaty between two countries. The goal? To prevent their residents from facing double taxation on the same income. This is especially helpful for NRIs who often earn income in India while residing elsewhere. These agreements ensure that you are taxed fairly and not burdened by the tax laws of two nations. DTAAs cover various types of income, including salaries, investments, and business profits. They provide a clear framework for determining which country has the right to tax that income, and at what rate.
What are the advantages of DTAA for NRIs? DTAs offer numerous benefits for NRIs. Let's look at some of the key advantages. First and foremost, DTAAs help NRIs avoid the dreaded double taxation. This means you won't have to pay taxes on the same income in both India and your country of residence. Instead, you'll only be taxed in one country or receive credit for taxes paid in one country against your tax liability in the other. Secondly, DTAAs often allow for tax credits. This means that if you've paid taxes on your Indian income in India, you can claim a credit for those taxes against your tax liability in the country of your residence. This effectively reduces your overall tax burden. Thirdly, DTAAs can provide for reduced tax rates. For instance, the DTAA might stipulate a lower tax rate on interest earned on deposits. This can translate to significant savings for NRIs. Lastly, DTAAs bring much-needed clarity and certainty to the often complex world of international taxation. By clearly outlining the tax obligations of residents in both countries, DTAAs simplify cross-border financial transactions and provide peace of mind to NRIs.
India's global DTAA network. India has a DTAA with over 90 countries. These agreements play a crucial role in attracting foreign investment and facilitating international trade. India has comprehensive DTAAs, covering a wide range of income and tax aspects, with major economies like the US, UK, Canada, and Australia. In addition to comprehensive agreements, India also has limited DTAAs with certain countries. These agreements may focus on specific types of income or tax issues. For example, India has limited DTAAs with countries like Bangladesh and Sri Lanka, primarily addressing income from shipping and air transport.
Important points for NRIs. While DTAAs offer numerous advantages, it's essential for NRIs to understand that specific provisions can vary depending on the type of income and the countries involved. For example, the treatment of capital gains from the sale of property may differ from the treatment of rental income. Furthermore, NRIs should remember that DTAAs do not override domestic tax laws. Both India and your country of residence have their own tax regulations, and these laws continue to apply even if a DTAA is in place. The DTAA simply provides a framework for resolving conflicts between the two sets of laws. DTAAs offer relief from double taxation through methods such as exemption and tax credit. Exemption means that the income is entirely exempt from tax in one of the countries. Tax credit, as explained earlier, allows you to offset the taxes paid in one country against your tax liability in the other country.
DTAA in action, a US-India case study. Let's look at an example to understand how DTAA works in practice. Suppose an NRI based in the US earns interest income from an NRO fixed deposit in an Indian bank. As most NRIs would know, interest earned on NRO deposits is subject to tax deduction at source. In such cases, the DTAA between India and the US steps in to provide relief. Under this agreement, the US resident can claim a tax credit for the TDS amount deducted in India against their US tax liability. There is also a provision for a lower TDS on the interest earned on the deposit. This means they wouldn't have to pay taxes on this income twice, effectively mitigating the burden of double taxation.
Navigating DTAA for NRIs. To determine if a DTAA can benefit you, start by checking if a DTAA exists between India and the country of your residence. You can find this information on the website of the Indian Income Tax Department or consult a tax advisor. Next, verify your tax residency status in both countries. Tax residency rules can be complex, so it's essential to understand them correctly. Once you've established the applicability of a DTAA, identify the specific type of income you're earning in India. DTAAs often contain different provisions for various income categories, such as salary, interest, dividends, and capital gains. Carefully review the relevant articles of the DTAA to understand the tax implications for your particular situation. Look for any specific conditions or exemptions mentioned in the DTAA. For instance, some DTAAs may provide complete tax exemption on certain types of income, while others might offer a lower tax rate or a combination of both. Understanding these nuances is crucial for maximizing your DTAA benefits.
Essential documentation for DTAA benefits. To claim DTAA benefits, NRIs need to maintain proper documentation. When filing your tax returns in India, you'll typically need to provide the permanent account number, commonly referred to as PAN. A permanent account number is mandatory for all financial transactions in India, including filing tax returns. The second important document required is a tax residency certificate. This certificate, issued by the tax authorities in your country of residence, certifies your tax residency status. It is crucial for claiming DTAA benefits and avoiding double taxation. The next document required is a Form 10F. This is to verify the NRI's qualification to seek the tax benefits as per the DTAA. Depending on the specific DTAA provisions and your income type, you may need to provide additional documents such as bank statements, investment proofs, and income proof.
Seeking expert guidance on DTAA. Navigating the intricacies of DTAAs can be complex, especially for those unfamiliar with international tax laws. It's highly recommended that NRIs consult with a qualified chartered accountant or tax advisor specializing in international taxation. They can guide you through the DTAA provisions, help you determine your tax residency status, and ensure you meet all the necessary documentation requirements. A tax professional can also help you develop tax-efficient investment strategies, taking full advantage of the DTAA benefits. They can keep you updated on any changes in tax laws or DTAA provisions, ensuring continued compliance and maximizing your financial benefits.
Conclusion: DTAA, a boon for NRIs. DTAAs serve as a valuable tool for NRIs, offering relief from double taxation and promoting cross-border investments. Understanding the provisions of the relevant DTAA and maintaining proper documentation are crucial for NRIs to leverage these benefits effectively. By seeking expert advice and staying informed, NRIs can optimize their tax obligations and make the most of their financial endeavors in India. We hope you've learned the basics of the provisions of Double Taxation Avoidance Agreement. Please subscribe to our channel for more such informative videos.